see you. If you're on YouTube, great to see you. Now, we do these courses every single Friday. And one of the major reasons for doing so is to be able to share financial education and literacy with really anyone that needs it. Anyone that needs it, right? Really quickly, I'm going to get Instagram up and running here as well. So I do these courses every week, and the purpose of them is growing up, I didn't learn about finances from anybody, right? And when I started looking, you guys have probably heard this story. When I started looking, the first thing I ran into was misinformation. Okay, I thought I was getting information about money. I thought I was getting information about finances. Really, I wasn't, right? It was actually stuff that in practicality, when I attempted to use it, it didn't actually work. You guys have to excuse my messing around on the side here with Instagram, but all right, we're up and running on Instagram too. So when I started to apply the information I was learning, it didn't work. And when I started to really look at, well, why isn't this stuff working? What I found was it was stuff that in theory sounded great, but in practical application, it wasn't actually something that I knew how to actually apply. I didn't know how to make this information about money like rubber hit the road, you know what I mean? Apply in my life so that I could actually see a benefit in it. And so for me, what that looked like was really, struggling with finances, struggling with money. It was a topic that I was kind of sore on. I didn't understand it. I didn't enjoy it. And it took me a long time to actually start to figure out, like, how does money actually work? And ironically speaking, it wasn't in any of the self-help books that I read. It wasn't anybody that was on social media or Instagram or any of the stuff that you see today, right? And so we're actually started learning about money was from people that had it. Ironic, right? Who would have thought I can learn about money from people that have it? But that's where I started learning about money from. I started studying. I call them old dead guys, people that historically had wealth. They've lived for hundreds of years prior than I did. And so I could actually go and see in their lives, like, yeah, these people have money. They had wealth. They actually had documentaries and biographies that I could go look at and study for myself and see, how do the wealthy people actually make their money, right? How does this actually work? And so that's really the track that I was on in my life, was trying to get all of this like lined out and organized for myself so that I could really start to apply it. And so as I started figuring that out in my life, I started sharing it with my clients and actually like helping other people do the same thing. And it was working. Okay. And so the reason I do these courses is even today, the information that I share, like it's so simple, but it's just not out there. It's not stuff that the average person ever learns. It's not things that we ever really pick up in our lives. And so I share these courses because I want to give the same information and access to information that I now have to really anybody that wants to get it, anybody that's interested in it. And it doesn't have to be a $5,000 online course. Like, we've been doing these courses every single week for like 3 years in a row now. Okay. Now, before we dive into this, again, really quick intro. If you're just now watching for the first time, I'm Jerry. I'm the CEO and owner, founder of Wealth Dynamics. And so what we do is we help people with our company. We help families and individuals become financially educated and wealthy so that they can navigate their economic futures with certainty and then help build more prosperous communities around them. Okay. That's our big mission and purpose. Okay. And every week I come to you guys with a course. If you've been watching before, you guys know the drill here. I want to hit some really quick house rules before we talk about tonight's topic, which is tax planning. Okay, how do we reduce our taxes? We're going to talk about that. We've done some courses on this before, but I want to give you some practical application. Now, really quickly, as you're watching this course, okay, first things first, no negativity allowed on these. Okay, I've gone through this every single week, but there's a bipartisan, I'm going to call it, right? Two groups of people that are going to watch this on a Friday night. Okay. The first group of people really cares about their finances, and they're willing to take their time on a Friday to learn about money. They're willing to, not go out. They're willing to not go out and party. They're willing to stay at home and watch this webinar because they care about money and they want to learn how to improve their finances. You are my group. That is why I'm here. That's why I'm teaching this course, because you matter. And I was the same way. And I want to give you the information and give you the respect that I think you deserve for taking the time out of your week to do this. Okay. The second group of people, mainly Instagram, have nothing better to do on a Friday night. Okay. So what they're going to do is they're going to play video games, watch porn, and troll. Okay. You can only do the first two so long. And then finally, the third one is the only option left. If you're that person, exit the stream. You can leave. Okay. We don't want you here. We're not going to talk to you. Your comments aren't funny. So I always have to get that out of the way, because for the second group, they think it's funny. For the first group, it's actually very distracting and disrespectful. Okay. So that's the first rule. Second rule, this is about money. Okay. This is about money and finances. So ask questions, like ask lots of questions, but make sure they're about money and finances. So we're not here to talk about politics or world issues or any of that stuff. This is about money. How do I get and apply information about money so that I can improve my life? Because at the end of the day, the two old white guys we vote for in November aren't going to fix that. Okay, that's up to you, right? So we're talking just about money. And then the third rule is, as you're watching this, if there's anything you don't understand, I want you to stop and clarify it. Ask the question, like, what does that word mean? What does that phrase mean? Or even better yet, go to your iPhone and pull up dictionary.com and look up words, Investopedia, look up words as we're doing this. Finances are a topic that they're designed to be complex. So I'm going to try and do my best to simplify them down so that they're not complex if they don't need to be. Okay, if they don't need to be complex, let's not make them complex. But I also don't want to do you a disservice where I make it so complex that you don't actually know that what I'm saying is applying to a certain topic. And then in life, when someone brings up the actual topic, you've got no idea what they're saying because I explained it to you like a 4-year-old, and life doesn't work like that. Okay, so there's some responsibility on my end. I'm going to simplify it, but there's also a lot of responsibility on your end on when you go apply for a mortgage or you do your taxes or you start investing. They're not going to explain it to you like you're 4. So you do kind of have to know the vocabulary and the terminology and the vernacular that's used in finances, because the world is not going to level down for you. One of the only subjects that's like that. Okay, because it was created on a bunch of arbitrary made up stuff by people that want it that way for a reason. So if I don't learn some of that information, some of that language, I'm at a severe disadvantage. So I'm going to make it simple, but also I want you to realize, like, that's part of your job is, all right, let me figure out what some of these terms mean, because it's important, right? So diving into this, I want to talk about taxes tonight. Okay, taxes and the tax code. Now, when I talk about taxes and the tax code, there's 2 different viewpoints on this. There is the viewpoint of what most people do, which is, at the end of the year, they pay taxes, right? December 31st happens, whatever money I made this year, I'm going to have to pay taxes on it, and I've got to pay those by April 15th. Okay, or if you file an extension, I've got to pay them, by October 15th. That was yesterday. Okay, that's probably 90% of America operates this way, where we earn income and then we actually we plan to pay taxes on the income. We already know, like, oh crap, I made money. I hope they withheld enough out of my check. Some people are so undereducated on this that they actually hope they get a refund. Okay, they're actually hoping that they overpaid, which makes no sense to me. And I can see the viewpoint because I used to think that way. But there's a point in my life where I didn't understand how taxes worked. So I was like, well, if I get money back, that's better than not. So I want to get money back. And so I thought getting a tax refund was a good idea. The reality of a tax refund means that the IRS took too much of my income every single month for the entire year, meaning I loaned them money. They held it for the entire year. They paid me literally no interest for holding my money, and then gave it back to me the next year and said, oops, sorry, we robbed you and took too much. Celebrate, go buy a TV and go to Disney World. Right? So that's not a good thing. That's called a tax refund. And so that was like my first learning experience with taxes, was that I don't actually want a refund. That's not a good thing. That's not something I should be desiring. That's not something I should be interested in. But most Americans, if you watch during tax filing season, you're going to see TurboTax and H&R Block and all of these companies, pushing to get you to file your taxes and get the refund. And they talk about how much refund money you can get. You don't want to get a tax refund. Okay. So that's the first gradient. Now, the second gradient is if I'm out of the mindset, for me, I graduated out of the mindset of I didn't want a tax refund anymore. I was like, okay, I understand that's bad. I don't want that. Right. But then I was like, well, I did make income, so I need to make sure that I just don't owe anything. Okay. I want to just not owe anything. So I'm going to make sure that I pay enough throughout the year. So I would adjust my paycheck and make sure that I wasn't underreporting my income, and that when the IRS took money, they were taking what I thought was going to be mathematically the right amount. And so that was my next phase of tax planning. Okay, now I call it tax planning because it's ironic. This can mean 2 things. Tax planning can mean I'm planning to pay taxes, which is what I was doing at that point in time. And then tax planning can also mean I'm planning on not paying taxes. Okay. There's a difference in mindset there. And that's what I'm going to go into tonight. So the average person, if they're out of like the refund mode and they're not like, I want my free refund, I want my refund, I want my refund, then they're more kind of in like a fear or skepticism. Like I earned income. I know I earned income. I know that I have to owe taxes on the income. And I hope that I pay them all because A, I don't want to owe, and B, I don't want to be in trouble with the IRS. That's where most people operate in the tax zone. So January 1st comes around and everyone's hastily, getting on their TurboTax, talking to their enrolled agent, their CPA, like, hey, let's get our taxes done by the 15th because they don't want to owe and they don't want to be in trouble with the IRS. So I was there for a while. Okay. The third degree of tax planning is realizing that you don't actually have to pay it by the 15th of April. You could file an extension. Okay. And not only could you file an extension, you might even be able to get some deductions. Okay. Now this is usually like by happenstance. When I graduated into this level of tax planning, it really was kind of an accident, right? I found out I could extend my taxes and I could wait until October 15th instead of April 15th. So then I was no longer gunning to file my taxes by January, right? So that monkey was kind of off my back. And then the next thing that happened was I realized, I could, take, deductions. I can write off some stuff on my 401k contribution. I could maybe do an IRA. Granted, I was giving my money to Wall Street, which I didn't realize was a terrible idea at the time, but that was better than just not paying any, than paying taxes and just not having a plan. So that was like the fourth degree there. And then when I finally got educated and I started studying, what do wealthy people do with their taxes? Right? What do wealthy people do with their taxes? We just saw a couple of weeks ago, Donald Trump, right? $0 paid in taxes. I think in 2016, he paid like $750. Okay. And again, those returns are unsubstantiated. So no one's actually proven that, but that's what's out there. And I personally believe it because I couldn't imagine a guy like that paying taxes. It's just not real to me. Right. So when I started learning about that, then I realized that there's two different mindsets with tax planning. There's what I call proactive and there's reactive. Okay, proactive and reactive. Reactive means that I earned income, didn't really think about taxes until the end of the year. Maybe I maxed out a few things. Maybe I filed an extension, but I'm still like in October, like crap. I hope I don't have to pay money. That's called reactive tax planning. Okay, that's how the average person does their taxes. And it's something that's not a good idea, but it also, like, I can't blame people for doing it that way. Because we don't get educated on how the tax code works. We don't get educated on how to reduce taxes. So while it's not the right way to do it, I can't really blame you for doing it that way because no one ever sits down and has that conversation on, all right, how do you proactively reduce your taxes? Okay. Now that is the second school of thought is you can be proactive. Okay. Proactive looks like this. It looks like at the beginning of the year, okay, the beginning of the year, I'm going to look at what do I project my income is going to be for this year. So that means in 2020, before all the COVIDs happened and everything blew up in the world, I would have sat down and said, here's what I think I'm going to make in 2020. Okay, based on what I think I'm going to make in 2020, I'm going to put a preemptive tax plan in place, something that is based on my projection into the future so that I have strategies throughout the year that I can work to reduce that tax bill. Right? Now, with that being said, I would then monitor that plan throughout the year, quarterly or monthly or however I'm doing this. I'm going to look at it in increments and find out, okay, here's what I thought I was going to make. What am I actually on track for? Okay. And if I'm not on track, then I make adjustments. If I make more than I thought I was going to make, I might add some things. If I'm making less than I thought I was going to make, I might take some things away. Right? Now, I'm going to do that all the way through to the end of the year. So in October, right? So we talked about the tax extension date is October 15th. So people have to file by then. Okay. By October, I pretty well know how my year is going, right? We're into the fourth quarter. There's only a couple of months left. So on October 15th, I'm going to sit down and I'm going to start projecting. All right, where am I at? How much have I earned this year? And what is next year going to look like? Right? By the end of this year, when 2021 starts, based on what I've done so far, what is my tax bill going to look like? And this is really where you get into tax planning. Okay, most people leave this completely alone. If you think about it, the average American doesn't do tax planning. October 15th is not tax planning season for the average person or the average family. It's the beginning of the spurt of Halloween and Thanksgiving and then Christmas and then New Year's. And we don't think about taxes at all because we basically take the entire final 2 or 3 months of the year off from everything. Okay, whereas wealthy people, they're actually proactively looking at how do I get rid of the taxes? Okay, that's the best Christmas gift in the world, right? So that's what I want to instill tonight, is that mindset. October 15th, might as well consider that tax planning eve, right? And then every single day after that until the end of the year, December 31st, we've got our mindsets on what am I earning? What do I owe on that amount that I'm earning? And how do I reduce that and get rid of it? And here's the problem is if you wait till after, because I have a lot of clients that don't know this and they'll reach out to me after December 31st. Once they start getting their W-2s, once they see how much income they made and they realize that they owe more taxes than they wanted to. And then they're like, what can I do? Well, there's not a whole lot you can do. There's maybe 2 or 3 things if you try and do this after December 31st versus if you do it before December 31st, there's no limit to the things we can do. Right? So I want to give you like the step-by-step, and we can actually mock this up with some fake numbers and show you what this actually would look like. But I want to give you the step-by-step procedure on tax planning. Okay. So the first step to this, and you guys might want to take notes on this tonight. The first step on tax planning is you've got to decide what you're planning for. Okay. There's the phrase, if you fail to plan, you plan to fail. So in tax planning, I don't believe that there's a neutral. Okay, when it comes to tax planning, I believe that you're either planning to pay or you're planning not to. And by not having a plan, by default, I'm planning to pay. So I've got to really look at, okay, which one is my intention on? Which one am I going to do, right? And so I've got to decide, am I planning to pay or not pay? If we're doing tax planning, it's because we're planning not to pay, right? Makes sense? So that's really the focus on this tax planning is we're planning not to pay taxes, and that's the purpose of tax planning. Now we're going to do it legally, which is why we want to plan. Okay, because anyone can just say, I'm not going to pay, and then, pull a Willie Nelson or any other number of celebrities that have gone to prison for tax evasion. Frickin' the most recent one, John McAfee antivirus, he just got obtained in Spain or France for tax evasion, right? So we can't just not pay. We do have to use the tax code. So that's the first thing. Now, on the subject of the tax code, I want to remind you, because a lot of us, when we start thinking about this, we get scared. When we start thinking about not paying taxes, if we're good, ethical people, we don't want to break the law, and we start getting worried and scared. I've had people that are like, am I allowed to max out an IRA? It's like, you're not going to go to prison for maxing out an IRA, I promise you. Okay, it's totally legal. It wouldn't be advertised if it wasn't legal. So there's this thing called the tax code. Okay, the tax code is literally like law. It's federal law, the rules of taxes that we have to abide by. Okay, just like any law, they start as a proposed bill, and then they end up as a bill, and then they get signed into law. The tax code goes through the same process, right? So with the tax code, it's over 5,800 pages in length. Think about that, 5,800 pages in length. I want you to think about the longest book you've ever read. Okay, what was it? 300, 400 pages, right? Think about something now that's 10 to 15 times that long. And they're not little book pages. These are full on, like you printed off something on your computer and it's like on a document, like over 5,800 of those types of pages. That is just astronomical. That's giant. Now, of those pages, get this, only 30 of them relate to the paying of income. So of 5,800 pages, only 30 of them relate to the actual paying of income tax. So if you do the percentage on that, that's like, I think 0.50%. Like it's just a tiny amount that actually is like pertaining to you have to pay taxes, which means the other 5,770 something pages are regarding not paying taxes. How do you get out of paying taxes? How do you legally not pay? So when you just look at that, and the reason I bring this up is to kind of put at ease the mindset of, well, I don't want to be too aggressive. I don't want to get in trouble. Guys, the tax code is literally over 99.50% of it is about not paying taxes. So don't worry about getting in trouble. If you follow the tax code, you'll be fine, right? It's if I'm not following the tax code, that's when I'm not fine. So the rules are there. We can clearly follow them. It's the equivalent of saying, I don't want to play a sport because I don't want to get in trouble with the ref over the rules of the sport. Then just freaking know the rules of the sport and you won't get in trouble. Okay, don't cop out of fear when you can actually go learn this stuff. So that's the actual tax code in size. Okay, now if I'm actually like looking at this, and I want to actually share my screen tonight and do some numbers with you guys. If we're looking at this in practicality, let's say that I am married with kids and I made, let's say that I made $120,000 this year. And it's October, and I know that that's going to be my income at the end of this year. It was 120 grand. I've got a wife and I've got 2 kids, let's say, right? So I'm married with 2 kids. When I look at that number, I need to figure out, what am I going to owe? What am I going to owe on this number? This is where I have to understand tax brackets and tax tables. Okay, there are literally brackets on, if I make this much, I'm going to pay this much. If I make this much, I'm going to pay this much. And I'm going to share this for those on Facebook and Zoom really quick, because I want you to see the bracket. If you guys are on Instagram, you won't be able to see the bracket, but you can tune in on Zoom or on Facebook if you'd rather be able to see the visual. So this is the tax table, right? So again, if I'm married, in my example, I'm married, right? This is going to tell me what are my tax brackets. So if I made $120,000, I have something called a standard deduction. Okay, the standard deduction is $24,800. That means the IRS is going to let me write off $24,800 off my income, whether I actually had those deductions or not. It's a freebie. I get them, and I'm going to use that number. So if I make 120,000, right, 120,000, and I subtract out my standard deduction of 24,800, that's going to put me in the 12% bracket. Right, the 12% bracket is going to be taxable income of anywhere from 44 grand to 105 grand. So 120,000 minus 24.8 puts me below the 105 grand number. I'm in the 12% bracket. So I know that on my first 44 grand, I'm going to pay 10%. Anything over 44 grand, I'm going to pay 12%, which means any dollar I can deduct has an automatic 12% annual return. You guys tracking with that? So when I'm looking at investing, guys, this is a guaranteed 12% return. I can't get that anywhere, right? So that's my mindset when I'm doing this. So I have to look at, what's my income going to be this year? If I shore up and I look at those numbers and I project them and predict them, then I can actually accurately kind of estimate what are my taxes. Now, a good way to do this, guys, is to look at last year's return first. So if I look at last year's return first, that might give me a realistic look on, like, if I'm a W-2 wage earner with a salary or an hourly wage, I can pretty accurately tell that last year's probably similar to this year. So sometimes I'll look at last year's as kind of like a supplement, so I can see, what did I earn? What did I pay? All those numbers are there, right? So I'm going to look at last year's return. I'm going to find out, what did I earn? And if I find out, okay, it's close to that 120, that means that last year's return is a pretty good projection of what would happen again this year if I didn't change anything. Okay, and I can also kind of play with hypotheticals. Well, what if on last year's return I did this? I can kind of also see the impact of what it'll do to my numbers this year, right? So I'm going to look at, what did I earn last year? Now, secondly, I'm going to look at, how did I earn it? Right? How did I earn it? This is an important question, because I can earn the income as W-2. I can earn it as dividends. I can earn it as interest. I can earn it as a 1099 self-employment income. I can earn it as a K-1 income, like a distribution from a business that I own or from a real estate deal. I can earn it as capital gains. I can earn it as a loan, which is tax-free. So there's a lot of ways that I could earn the income. Now, we're not yet into the planning and proactiveness at this. We just need to go understand what happened last year. How did I earn the income? So I'm going to figure out, did I have a W-2 wage? Was it business income? Was it investment income? And I'm going to figure that part out of this, because that's going to help me dictate, again, if I do things similarly, they're going to happen similarly. So I need to understand my baseline. Now, the other thing I'm going to look at then is, I figured out, what did I earn? How did I earn it? Then I'm looking at, what did I write off? Okay. So what did I write off? Again, I get the standard deduction of 24,800, but I can also do something called an itemized deduction. An itemized deduction means that if I really did factually spend more than $24,800 that year in deductible personal expenses, I can opt for that number instead if it's bigger. Now, most people don't have more than 24,800 in personal deductible expenses unless they, closed on a mortgage or something of that nature, where they have just like a huge, gigantic number. They're doing a lot of charitable donations, right? So I'm going to look at, what did I write off last year? Okay, the average person, the number is not going to be big. It's not much. They didn't write off much. And again, I'm looking at this so I can get some context. Now, once I've looked at that, I look at, if I did get some write-offs, where did they come from? Because I want to repeat that this year. If I did get write-offs and they did count and they did help me, I need to repeat the successful action. Guys, this is part of tax planning. Tax planning is a level up system of getting things that work, repeating those and then adding more things. So year to year, like you might have just one layer of like, I did this last year and it worked. Next year, I'm going to do this again, and I'm going to see if I can add. The year after, I'm going to do this and this again. I'm going to see if I can add more. And so I should always have that bottom, 2 or 3 or 4 layers being consistent year to year, because it's basic things that work. And then I'm looking at creative strategies in addition to that to further reduce my taxes, right? So when I get that down on what did I write off, I can then start to look at, can I do this again similarly? Do I have things that I can repeat this year? Okay, again, key thing here is if you're writing things off, you need to have documentation and details. So I can't just write things off, and then if I get audited, the IRS comes and I'm like, oh, I just figured that was the number. No. I need to actually be able to show them a receipt or a bank statement or a credit card statement where I can show them, here's the documentation of what I wrote off, and then here's the details of why. Right? If it was a business meal, like why was that a business meal? What was I doing? Was I asking for referrals? Was it a client meeting? Was it a working meeting? Like, how is that a business meal? That's the details. And then what's the document? Do I have a receipt, an Excel spreadsheet, a credit card statement, whatever it might be? So that's key if you're doing write-offs. Okay. So I have that documented and detailed. And then again, like part of this, guys, is not just for IRS audits, but it's also for your clarity. If you look at your tax return and you just see 120 and you're like, well, I had, let's say I had $20,000 in business losses and you didn't document any of it. Like A, you're at risk if you get audited, but B, how the hell are you going to repeat any of it next year if you don't know what it was? Right? It's kind of like cooking and never writing down your ingredients. Like make it easy on you too by doing some accounting and bookkeeping throughout the year. Right? So let's say that I have, $20,000 in write-offs. Now, once I have this down, and again, the documentation helps with this, I'm also going to look at last year's return. Did I miss anything? Okay, part of tax planning is not just reducing this year's taxes, but a lot of times when you just start doing this, you're going to start becoming privy to what could have been done in previous years. And you can actually go and amend those returns, meaning you can change them, add the numbers that maybe you missed. Like maybe you didn't know you could have written off your home office even though you had one. Or maybe you didn't know that because you bought a work vehicle, you could have written off the accelerated depreciation of it, and you didn't do that. And so you could actually go and refile and say, hey, I had this, and this that I missed. Refile and get some money back. So that's always the first thing I'm looking at. Can we refile? Can we amend? But I can't do any of that if I don't have documentation and details, because then I don't actually know what I did do or didn't do. And then it makes it just very confusing to go amend anything because there's no context. So I'm going to look at, did I miss anything? Can I amend it? If so, I'm going to amend my last year's return. So in this case, I'm looking at, let's say this is 2019. I'm looking at, I made 120. I wrote off $20,000. Let's say these are business losses. And I had, my $24,800 standard deduction, right? But I'm going to look at in this 20,000, what did I write off and what could I go back and redo if I missed it? And if I could, then I'm going to amend 2019's return. I'm going to pay some money to do that. But if I'm going to get more back than it costs, it makes sense to do. And then I'm going to refile and get the money back. Okay. Now the benefit of doing it this way is if I was able to amend my return and then go back to this year now, 2020, whatever I amended last year is probably a doable on this year's return as well. So again, I'm just making it easier. I don't have to be as creative because there's 3 or 4 more things that I realized last year I should have done and didn't do that I can now take and do them this year in a new unit of time because I realized last year I could have. You guys tracking with that? So this is all just like the basis of like, I looked at last year's return and I looked at all the numbers and I looked at the deductions and I looked at my documents and my details. And if I was able to amend and make changes, I did. And if I made changes on the amendments, I'm going to use those again this year as well. And I'm just adding to my arsenal so that this can be simple every year. Right. So when I'm finished with that, and I know that that's a lot, but when I'm finished with that, now I'm finally going to start looking at 2020. I'm finally going to start looking at this year's return, right? So the first thing I'm looking at is, again, I'm going to erase some of these numbers. So we talked about the first thing that I'm going to do here is I'm going to look at what am I on track to earn? So let's just say for simplicity's sake, I am still on track to earn $120,000. That's still going to be my number this year, okay? So what am I on track to earn? And again, how and where? So I want to look at, is this from W-2 income? Is this from 1099 income? Is this from rental income? Like, where is this 120 coming from? right? And then a big part of this is based on where it's coming from. Can I restructure my income? Okay, an example of this, who here owns real estate as an investment? Okay, some of us do, right? With real estate, there's something called a passive loss. So real estate, if you spend, I think it's less than 750 hours a year or 1,000 hours a year, whatever the number is, if it's less than that, it's considered passive income. And there's a limit on how much the IRS will let you lose on passive income because passive losses are capped. Okay, so let's say that some of this income is rental income. The benefit of real estate is writing off depreciation and writing off losses and different things that can bring my W-2 or my 1099 income down because my real estate can show a loss, right? But if it's passive and this loss is capped, that means that there's a point of diminishing return where if I keep doing real estate, I'm not going to see any benefit if it's passive because I hit my cap already. So what's common is a person will just be like, okay, well, I can only take this much in losses. Sucks. Oh, well, that's it. And then they just go on and they overpay in taxes. What we could actually do is we could incorporate your real estate. Okay, when I say incorporate, I mean we're going to set up an LLC. We're going to elect to file it as an S-Corp. And by doing this, you are able to actually take a active loss on your real estate. It's no longer passive. Now it's a business. So if the cap on real estate losses was 25,000, I can now lose more than that and write it off because my corporation doesn't have a limit on how much it can lose. Okay. People are terrible at business all the time. They lose money all the time. There's no cap on it. So I could then show, and this doesn't even mean I actually lost money on my real estate. I could have been profitable, but on my taxes, there are ways to show losses. And if I run it through an S corporation, I can still have that loss. And now it's uncapped. This is by definition, me taking this rental income and restructuring it to now be corporate income. I have income flowing through my corporation and I can increase my losses now. Okay, a lot of people don't know that I can do this, but that's in the tax code. So I'm going to look at how can I restructure things, okay? If I'm a 1099, let's say I'm a salesperson. If I'm a 1099 and I am not opting, again, with an LLC that is filing as an S corporation, then I'm going to pay self-employment tax on all of this income. That's an additional 15%. Okay, who here is in sales? Salesperson on commission income, 1099 income. Who here would enjoy paying 15% on top of your income tax just because you have self-employment income? Right? So I can restructure my income. I can say, okay, this is 1099 income. I know that if I keep it as 1099 income and I file as a sole proprietor, that I'm going to overpay in taxes. So I can restructure this income by setting up an LLC, electing to file it as an S corporation, running that income through the corporation. And now I can avoid my self-employment taxes on the majority of that income. Right? This is all restructuring. How do I restructure before we start getting into deductions? Because guys, deductions take effort. Deductions is like, I've got to think and I've got to document, I've got to track. If I can just restructure income, that's like a sweep across all of my income. It's a one-time thing. I don't have to think about it every day. There's no documentation. I just have to show the IRS, I have an S corporation. Because I have an S corporation, all of this income that I have in my S corporation gets split between a base wage and a distribution, and anything that's a distribution does not have self-employment tax. Therefore, you can't have more of my income. And then I'm good. Like that's my filing basis from here on out with that corporation. So it's important to know this stuff, right? So can I restructure my income? Okay, the other thing I can do if I'm a high earner, I can set up a C corporation. Okay, there's all sorts of different legal entities you can set up. One of them is called a C corporation. Doesn't mean anything to you other than the IRS will treat it as a separate person and it does not flow through to your tax return. So you could then set up a C corporation as an example of if you're a high income earner. C corporation has a federal tax rate of 21%. So if your personal rate is greater than 21%, then you could take your 1099 income, flow some of it through to a C corp. If I flow $80,000 to my C corporation from my 1099 income, that C corporation would have a lower tax bracket than I would personally. That C corporation can take that $80,000 and pay it to me as a capital gain. capital gains under $80,000 are income tax free for me personally. So I would pay no taxes and I would pay the corporate rate of 21% instead of 25 or 30. Right. So that's another way of restructuring my income. A C-Corp can also do something called fringe benefits. It can pay for my gym memberships. It can pay for my auto insurance, my health insurance, all sorts of things that my business usually couldn't write off. My C corporation could. Right. So I need to look at, is my income structured properly? Because if it's not, and I don't change it, then it's inefficient. I'm going to overpay in taxes just by nature of the corporate setup. Okay. So that's an important thing to look at. Now, let me stop my share here. Now, as we're going through and we check off, is my income structured correctly? The first question I'm going to ask is, again, if I'm filing for 2020, in 2020, am I going to take an itemized deduction or am I going to take a standard deduction? I need to answer that question next. Okay. Now, we just talked about standard deduction for me, if I'm married, is going to be $24,800. Whether I spent that much in deductible things or not, I'm going to get that no matter what. Okay. Now, if I can itemize, that means that I would have to have more than $24,800 in itemized deductions. And I would need to count that up and make sure, again, that I have the details and the documents to prove that those are real deductions I can take. So I'm going to answer that question. Now, for this example, just to keep it simple, let's say that I'm not going to itemize. Let's say that I'm going to take the standard deduction. Okay. And I say that because unless you're doing a ton of charitable giving, or like I said, you closed on a mortgage or you did something out of the norm, right? Then you're probably not going to get an itemized deduction. A lot of people don't end up with that. They get the standard. So let's say I take the itemized deduction. Now, if I'm a W-2, let's say that, again, most of my income came from W-2 wages. Let's pretend that I'm an average everyday family and I have W-2 wages. I'm going to look at, can I take a loss on a side business? Okay, this is so important. There are ways that I can classify my expenses that I'm going to spend anyways. Right? I'm talking about meals. I'm talking about my cell phone. I'm talking about travel. I'm talking about vacations. I'm talking about courses that I might take, books I might buy, right? Events that I might go to. These are things that I probably would spend money on anyways, that typically are not tax deductible for me personally. But if I have a business that's a side business and I route them through that business, doesn't matter if that business is profitable or not. Okay, so it could be multi-level marketing. It could be, Herbalife, Advocare, Plexus, Primerica, well, you name it, whatever the company is. And you can take that company that you're now doing as a self-employment activity and route all of these things you were going to spend money on anyways through that business as an expense for that business. Again, it has to be legitimate. You have to have documentation and detail to prove that it's legal and that it's allowed to happen. But if that's the case, you can write all of that off. Okay, an example that I'm going to give you guys is a tax return that we just helped with. Okay, and I'm not going to show you the actual return, but I'll show you the rough numbers. So this guy made about 60 grand in 2019. Okay, he's single, right? So his standard deduction was going to be $12,400. All of this was W-2 wage. He didn't have any self-employment income, right? So we looked at the first thing. What did I make? Okay, 60 grand. Okay, how did I make it? I made it W-2, right? Am I going to itemize or take the standard deduction? We're going to itemize because he didn't have enough money for a standard deduction. Do I have a Schedule C loss? Meaning, did I have some kind of a side business or multi-level marketing that I can write off expenses for? Okay, initially, and this guy did, but initially he was kind of apprehensive about, like, I don't know what I can write off and what's legal. Like I was saying, like the getting caught up in the tax code. Like, am I going to get in trouble if I write this off? Can I? Am I allowed to? And again, so he didn't write any of it off at first. So he submitted his info to us and we're like, bro, you're going to have to pay I think it was like $5 grand extra in taxes because of the way that he set his expenses and stuff up. It was just this number minus this number, and he's going to pay taxes on the difference. So what we said is, we're like, hey, that's bullshit. Like, we know you spent more than that on business stuff. We know that you have an MLM that you're involved in. So what can we write off through this MLM? So we gave him some suggestions. Can you write off office space? Yep, good. Let's do that. Did you go to any events? Were those events for this business? Good. Let's write some of those off. Okay. Did you do any traveling for this business? Yes. Good. Let's write this off. Did you have any meals and entertainment costs for this business? Good. Let's write those off. So what we found on this was that in this business, which is, again, self-employment income, he made like $1,200 in like commission. So it's not something he's like pushing heavy on, but it is something he does. Like, there's a real business there. However, he had $17,000 in expenses that we were able to justify running through that business. $17,000 in expenses. So what this does is that's now gone. He spent way more than he made, but we now have, what is that? A $15,800 loss. So when we're doing his taxes now, we can say, hey, we have 60,000 earned, right? We have the standard deduction of 12.4, but we also have negative, let's call it 16 grand on top of this in business losses. And again, all of this has to be documented, and you need to have details proving that these are real transactions, right? So for this particular guy, we took his tax burden down from like 5 grand to I think $1,000. Okay, $1,000. Now, this is not somebody that overpays. At the beginning of the year, we also took a look at his Form W-4 and we reduced it down so that the IRS was taking the minimum amount of money they possibly legally would be allowed to take out of his paycheck. So he's already underpaying every month. And because he was underpaying every month, if he didn't do any Schedule C losses here, he would have owed the IRS 5 grand. So by doing this step here, which took all of a couple hours, he was able to save 5 grand in taxes by writing off about 16 grand in business expenses. Okay. Take the time invested, 2 to 3 hours, and divide 5,000 by that. Okay. None of us have anything better to do with our time. If you're getting paid, $1,500 an hour to reduce your taxes, that is time well spent, right? So we're ending up now with $1,000 tax burden. That's a real life application of like taking Schedule C losses, having a side business that I can write off expenses against my W-2 income and my other income. So I need to look for, do I have those? Can I take some Schedule C losses? Now, the other part here, now everything, just really quick, everything we've done up to this point is not new expenses. Meaning these are things that you're already spending on. We're just making them tax deductible by routing them through a business activity, right? So we're not getting into the realm right now of getting rid of money for the sake of lowering taxes. Now that might be something we get into, but I want to just draw a fine line here, okay? If this is a conversation with somebody that currently has debt, if I have consumer debt, if I have a car payment, if I have credit cards, if I have student loans, if I have any kind of debt, I don't need to be trying to spend money to reduce my taxes because my debt costs me more than my taxes do. So if I have this dollar and I can keep it and then pay off my debt, which is a higher cost than my taxes, I need to do that. Okay. It wouldn't make sense for me to spend the dollar to reduce my taxes when I could have kept it and paid off my debt, which was more expensive than the taxes. Okay. Taxes are once a year. Debt is residual, meaning if I have a 5-year car loan, that's going to cost me more money over more time. Taxes, I can get rid of money this year, boom, it's gone. Next year, I can do the same thing, right? So it's not a residual, it's a one-time event that happens each year. Debt is not, it's a recurring event. So my point is, if I have debt, that's my focus. I need to get rid of the debt first, then we go after taxes. And the reason I say that is the next couple of things we're going to talk about are only for people that don't have consumer debt, okay? So this is where we draw the line. And if you have consumer debt, you do not go past this point. If you don't have consumer debt, then we're going to take the next step. Okay. So the next step would be this. I took my Schedule C losses. I did everything there. I'm going to try and max out a health savings account. Okay. Again, if I'm doing this as a married couple, I can put away $7,100 into something called a health savings account. And I can write that $7,100 off against my income. Right. So again, in our example, and let's make this a little bit less intense. So let's say that I have that 120 grand that I was talking about in income. Let's say that most of this was W-2. I'm taking the standard deduction of 24,800. But even prior to that, I'm taking Schedule C losses. So let's say that I was able to write off $5,000 in business losses. In addition to that, I'm going to do the HSA. The health savings account. Okay, the health savings account is going to allow me to write off $7,100 in addition to my Schedule C loss, right? So I want to take that. Now the Schedule C loss is great, but it's also not really money I'm keeping. It's money that I was going to spend anyways. The HSA, I'm taking money out of my budget and I'm putting it into this account, right? So I'm going to max out my health savings account. In order to do this, I do have to have a particular kind of health insurance plan to qualify, but it's not that hard to do. So I'm going to do that. I'm going to get my $7,100 deduction. Now, also, I don't personally contribute to a 401k at work. Okay. I contribute to my own stuff. I set up self-directed. So my HSA is self-directed, which means it's not going to a bank or Wall Street. We're setting it up for you and you're directing your own investments. You're doing gold, silver, real estate, whatever it might be. Right. So that's the first thing. Second thing I'm going to do here is I'm going to max out my IRAs. So I'm going to do self-directed IRAs. That's another 12,000 that I can max out between me and my wife. So 120 grand. If we do the math on this, we've got 120 grand, right? And I'm just going to show you if we calculate out, if my calculator will open up. I don't think it will. Okay. So if we calculate out the math here on this, oh, there we go. Calculator. There we go. So we've got $120,000. Oh, we got a bunch of calculators that open. Good. I clicked the button like 10 times and now all of the calculators opened, which is great. Let me pull it back up now. Okay, great. So we have our $120,000 and we subtracted out $5,000 in Schedule C losses. That brings us down to 115. Then in addition to that, we did $7,100 in HSA contributions. That took us down to 107. In addition to that, we also did $12,000. Oops, I think it was 107.9. We did $12,000 in IRA contributions. So that brings me down to 95,900, right? Now that I'm below 104, I could also max out my 401k in addition. So if I do want to do a 401k, I could do another 19.5 for me, another 19.5 for my wife, right? So now I'm down to 57 grand in taxable income. These are all things that I can look at. Now, if I want to get my taxes lower, even lower than this, let's say I have my 2 kids. Okay. My business can pay my 2 kids up to $12,400 tax-free for them to help out with my business. Even if the business doesn't have the money, the business can lose money by doing this. So let's say that I also want to do that. I can pay my kids $12,400 each. Right now, when I pay them, that can still be household income. So a lot of people, when I talk about paying kids, they're like, well, I don't want to give my kids $12,400 because that's like $1,000 a month. And A, we can't afford to do that because we still have to pay bills. And B, I don't want to give them that much money. No, you're giving it to them on paper. Okay. You're paying them. That's still household income. You can still pay the bills with it. You could save some if you want to, right? But they can contribute to the household. So I can still on paper say, hey, the business paid the kids $12,400. Again, documentation and details. I would actually have to pay them. I would have to do an actual like official payment with, pay stubs, and they'd receive the income. Then they deposit the income, and then the income could go towards the household. Right. But by doing that, I just brought my taxes down, my income down to 32 grand. Right. So that's another thing that I'm going to do there, because that's going to help me out quite a bit. I want to share this with you guys actually, so you guys can see the calculator here. So I'm down to 32 grand, right? Now, in addition to that, I can also write off real estate losses. Okay. So if I own a home, my house can be rented to my corporation 14 days a year. I can pay myself from the corporation and then write that off. So I receive it tax-free. The corporation doesn't pay any taxes on it because it's a deduction, right? So I can charge my corporation money to use my house for conferences or business meetings, whatever it might be. And I can do that 14 days a year. And I can write off like market rate conference room meeting rates. If I called the Hilton or, whatever hotel is downtown in my city, I can find out, what do you guys charge for your conference room each day? That's the comparable rate. I can charge myself that rate for my house, right? So we're down to 32,100. So let's say that the rate is $400 a day, and I can rent my house to myself 14 days a year. That's another $5,600 that I can write off now. So 32,100 minus the $5,600 that we just wrote off on the house. Now my income is down to 26,500. Now, let me ask you, did I actually spend $400 a day? No, I did not. My corporation did, and that went to me, but I didn't actually spend money physically. Like, the money is still there. So that's what I'm getting at, is some of this stuff, we're going to get rid of money, like the HSA, the IRA, we are going to put money into this. Some of this is just paper trail. Like, the money didn't actually go away. It just changed from this entity to this entity. under the circumstances of renting up the house or paying the kids or whatever it might be, but the money is still there and available, right? So that's important to see. Now, the other thing I'm going to look at too is how much did all this cost me to do? Okay, I might have set up an S corporation. It might have cost me $1,500 to set up a corporation. It might cost me $2,000 for my tax planning. Like I might have a good $3,000 or $4,000 just in expenses doing that, which I can write off through my business as well. So let's say that I spent, $5,000 to do all this fancy tax planning. Okay, now my income is down to $21,500. Okay, now if I really, really, really want to get my income down further, what I could do is at the end of the year, I could lease a vehicle and pay for the entire lease up front, which gives me a discount on it. And then I can write it off on my taxes. So let's say that I had 20 grand in my sacred account and I wanted to buy a vehicle this year anyways, and I wanted the tax deduction, right? So I could take this, let's say I did a 36-month lease. Yes, I could get a $600 a month vehicle. I could pay it all up front in December, 36 months worth, which is $21,500. I'd borrow that out of my sacred account, pay the dealership for it. They would give me the lease. I'd have no car payments for the lease anymore. I would make car payments to myself now, and I would be able to write off $21,500. Okay. So I just took the final $21,500 off my taxes. I've just shown you how to go from 120 down to 0. All of that's legal. Anybody could do that. And the only reason that I was able to show you is because I understand the tax code. Now, guys, the crazy thing is I didn't even get into anything advanced. When you're a sophisticated investor with a $250,000 net worth, or you're an accredited investor with $1 million net worth, like there's more stuff. This is literally the basic stuff. This is the vanilla. This is you got the very the number one combo with fries and a Coke. This is nothing special. Anybody should be able to do this. Everyone should be doing this. Okay. And the only reasons you wouldn't is 2 reasons. A, I don't understand the tax code. So therefore either I don't know or I'm afraid to. And so that lack of knowledge, it prevents me from doing anything. Or B, I agree with paying income tax. So I don't want to lower my taxes because I think I'm being a good citizen by paying them. I know what the budget looks like federally, so I don't have that consideration. I don't think that paying taxes is helping. I think it's actually enabling a problem, right? So if you're in the first school of thought of like, the only reason I'm not doing this stuff is because I don't know how and I'm worried and I don't have guidance, that's what my firm is here for. Okay, if you're in the second school of thought where you're like, yeah, pay your taxes, it's a good thing, roads and schools, this video is probably not for you anyways. I'd be surprised if you're still watching, right? But if you're in that first group, this is the point of this video, is to show you what's possible. I just showed you how to take 120 grand in income and literally take it down to 0, which means you'd pay 0 taxes, right? So this is possible, but it's not possible if I don't plan for it. That's why I'm saying October 15th to the end of the year. October 15th to the end of the year is tax planning season. We are planning not to pay taxes. We're going to implement strategies. We're going to invest in tax planning to reduce our taxable income. Now, there is a group that's watching this that's going to scoff at the price. They're like, well, I don't want to pay $5 grand for setting up an entity and doing tax planning and filing. Okay, well, I just brought your taxes to 0. Okay, let's look at what they would have been if you didn't do this, right? So we said you made 120 grand, right? So at 120 grand, your only thing you would have gotten was a standard deduction, right? So if we say 120 grand minus $12,400. Actually, this was a married couple, so it's going to be $24,800, right? So you're going to pay 10% on your first 44.5. So you pay 45.50 just on your first, chunk of money that you earned. So 44.55 is what you would have paid there. Anything up to the 95 level. So let's subtract out the 44.550. Anything here is going to be taxed at a rate of 12%. So that's another 6,000. Okay, so if we add those two numbers together, if you didn't do any of this stuff because you were too cheap to invest in tax planning and you were trying to not pay money for a service, you would have paid $10,533 in federal income tax. Or, you could have spent $4 grand, $5 grand, $3 grand, whatever it is, to set up entities and do tax planning and pay nothing. So what costs more? Spending $5 grand on tax planning and entities or spending 10 grand on taxes? Guys, that's a 200% return. Like you doubled your money. You spent $5,000 and saved 10. Excellent return, right? So that's the point that I want to make here tonight. What I'm going to do is open this up for some quick questions. I do want to hit Instagram first because they run out of time after about an hour. All right, let's see what we got on Instagram for questions. Good to see everybody tonight. I am excited that we have so many people tuning in on a Friday to learn about tax planning. David Mejia says, will you raise a red flag if you file for an extension every year? You're not going to raise a red flag if you file for an extension every year. But here's the thing is the extension is really only going to be like the first couple of times, right? So if I've never done any of this, and then all of a sudden I start, logic stands to reason that prior to doing this, I'm going to have, stuff I can go fix. Now, if I'm already doing all this stuff, then next year, there's probably not going to be stuff to amend on this year because I already did all of this, right? So all my stuff should be pretty lined up. If I'm doing the right behaviors, then I shouldn't have to go back and keep amending things. The amending is more so like if, prior to doing real tax planning, if I was just doing TurboTax or I was working with a CPA that's really a scared dog with his tail tucked between his legs and he's not helping me with any tax write-offs. That's why I would amend stuff. So you're not going to raise a red flag by amending, but also by switching your behavior and your planning, the need to amend kind of goes away after the first, year or two. All right, let's see what other questions we have here on Instagram. Yeah, playing with the rule book that's provided. That's exactly right. Brock, good to see you, man. IRS is punching the air right now because of Jerry. I like it. Let's see if we have any other questions. Bria, good to see you. Let's see. Awesome. I think that's everything on Instagram. So we're going to shut them off for tonight. You guys would not believe some of the weird random comments I get on Instagram. Okay, let's check out Facebook and Zoom now. I want to see what questions we have on Facebook and Zoom. Okay. So let's see what we have on Zoom here. All right, I don't see any questions there. Let's check over here. Brian, good to see you. Good to see you. Okay, let's check Facebook next. Again, if you guys have questions on any of this stuff, don't hesitate to ask. Okay, Sean King, great to see you. So Sean has a good question. Can I obtain a tax code book? So Sean, you can actually read the entire tax code. I think Cornell has an online site with the entire tax code. Have a dictionary. That's what I'm going to say. It's have a dictionary because there's a lot of terminology there. And it's easy to get lost. But again, this is stuff that was designed to confuse us. So when you realize it was designed to confuse us, then it becomes a lot easier to track with. Sean says, I have lack of knowledge. Most of us really do. So don't feel weird or odd because you don't know how this stuff works. The bottom line is the desire to learn. And if you have the desire to learn, then it's going to be much easier for you to do. But this is stuff that's out there for everybody. Like we can look in awe at politicians and wealthy people that pay little to no income tax, but we have to realize they're using this exact system. So that's what I would say there. Let me see if there's any other questions on Zoom. John Moss says, so now is the time to prepare. So that's exactly it. So now would be the time for tax planning. Now, again, if you're, two schools here, if I don't have debt, then I'm going to be doing, HSAs and IRAs. I'm going to be taking money out of my budget and putting it places. If I do have debt, then I'm going to probably do like some Schedule C losses, paying kids, like different things that might not actually take money out of my budget because I want to pay off my debt first. So yes, it's time to prepare, but also whatever school you're in, whatever side of that house you're in, you want to focus on it that way. Just because it's more costly if you keep debt, or if I don't have debt, then more power to me. I can go put money towards all sorts of things. Robin says, can you only incorporate as a C-Corp if you're a 1099? So Robin, if you're 1099, you can incorporate as a C corporation, an S corporation, partnership. Like there's all sorts of ways you can do it. If you're a basic 1099, my usual thought would be to do an LLC, limited liability company, and then elect to file it as an S corporation. John says, can I open a business this year for next and coming year? So John, you can open a business. You could this year. Now you're only going to be able to write off expenses this year from the time you actually were like in that business moving on forward. So if I didn't have a business and then today I started one for 2020, I would really only be able to write off expenses from October 16th on. Right now for 2021, I had the business the entire year, so I could write it off for the whole year. That goes for incorporation too. I want to hit that really quick. If I incorporate, this month, I can't claim like my incorporation from the beginning of 2020 till now. I can only do it for the period of time that I was incorporated for. So it's important to know that. And that's part of what we help with. So if you're working with us on setting up corporations, doing your tax planning, those are the things we guide you on. Let's see here. Can a W-2 wage earner incorporate? So a W-2 wage earner doesn't need to, because you cannot take W-2 wages and then push them into a corporation. It's not self-employment income. So you wouldn't be able to legally say that W-2 income belongs to the corporation. You always can have an LLC. And that's what, guys, I totally recommend this. If you're a W-2 earner and you're writing off business expenses, even if it's not anything to do with the W-2 income, let's say that I decide I want to sell Color Street, multi-level marketing with Color Street. I could do that, but I'm going to have a much easier time justifying my deductions if I have an LLC for that. Sole proprietors that don't have any sort of entity set up to represent their business are a haven for audits. So just by having an LLC, it kind of fends the IRS off, because they say, okay, there's actually a business there and we can see that, versus me saying I'm a sole proprietor and them saying, great, we don't believe that you're actually doing any of these things. Let's audit you. Let's see here. Miss V says, what's the W-4 magic for minimum? So there's actually a W-4 calculator. That's a good question. A W-4 calculator on the IRS website. So if you type in IRS W-4 calculator, it'll pop up a calculator, and you can actually go through that calculator and you fill in your income, your pay stubs, all of the information it asks for. And it's going to tell you, like, based on what you're having taken out, are you going to get a refund or are you going to have nothing? And if you're getting a refund, you can dial it down to where you have no refund. And then it'll say, great, you need to enter these numbers on your W-4 and turn it into your employer so that they're taking out less money. So that would be my recommendation there. Again, just Google W-4 IRS calculator and you'll see that. All right, let me see if there's any other questions here. No, I think that's it. So guys, I'm going to go ahead and let me check Zoom one more time. Don says, thank you for the valuable information. My pleasure, Don. I'm glad it's something that's helping you. It cracks me up. My viewership on Facebook, I can tell, is down tonight, which just goes to show like how complicated this stuff sounds and how unwilling people are to confront it. Okay, the more complicated it is, the juicier it's going to be for you if you confront it. That means that there's more potential gain for you. There's a high barrier to entry for a reason. So if it sounds complex, like that's the dragon to go tackle and understand, because that's probably complex for a reason to keep people out, right? So I'm very happy with everyone that watched tonight. I hope that you learned something. By the way, if you're watching this and you're like, hey, I would like some help with tax planning, reach out to us. We will do a free review on your taxes for 2019. Like I talked about at the beginning of tonight, reviewing, the beginning of the year from last year and then looking at this year. We'll review last year for you at no cost. Okay, so we'll do a free review. We'll give you some ideas. If we think that we can save you more than our fees would be, then we'll propose, hey, let's help you with your tax planning for 2020. And you'll clearly see that, based on our recommendations, you're either going to save more than you earn or than you costed, or it's going to make you, less than it costed, and it's going to make sense, or it's not going to. So guys, that's all I have for tonight. Thank you for watching. Make sure you do like, share, and subscribe. Really share this one. Make sure you share it if you can tonight, because this is information everyone needs. Everyone can do this. There's literally no barrier to entry. If you have US income, you can be doing this, and you should be doing this. Thank you for watching. Have a great night. I'll talk to you next time.